Recently, some of my clients were asking me, upcoming homeowners with mortgage renewal should stick with fixed or variable mortgages. And here is the answer from my AI mortgage advisor. Right now, the decision between a fixed and variable mortgage at renewal is complex, especially in a falling rate environment. Based on the recent Bank of Canada rate cuts and current forecasts, here is a detailed breakdown to help you decide. Fixed versus variable at renewal. The key takeaway from the recent rate cuts is that variable rates are now often lower than comparable fixed rates for the first time in a while, and most forecasts expect rates to continue a moderate decline into 2026. Current variable rate mortgage typically lower than the fixed rate. Rate and your payment will drop as the Bank of Canada cuts its policy rate. Historically, over the long term, variable rates have been shown to cost less than fixed rates. Penalty to break is generally lower, about 3 months interest. Fixed rate mortgage is the safest choice, but currently higher than variable. Rate is locked in for the term, regardless of BOC changes, and provides certainty and stability in budgeting. But penalty to break can be substantially higher than variable mortgage. Interest rate differential calculation. Arguments for choosing a variable rate. If you believe the Bank of Canada will continue cutting its policy rate and you want to capitalize on those potential savings, a variable rate is likely the best option. For lower interest costs. If rates continue to fall, your interest rate and payments will decrease, saving you money over the term. Historically, variable rates have outperformed fixed rates. It's cheaper to break. If rates drop significantly, you may want to break your mortgage to lock in a new, lower fixed rate. The penalty for breaking a variable mortgage is usually much lower, and the current gap between variable and fixed rates is narrow, making variable an enticing option. Arguments for choosing a fixed rate or a shorter-term fixed rate. If you value predictable payments or are concerned about your budget, a fixed rate offers a hedge against uncertainty. For budget certainty, your payment is locked in and will not change, making monthly budgeting simple and stress-free. And risk aversion. If a potential future rate increase would cause financial strain, fixed is the safer choice, as many economists predict a pause in rate cuts and a possible gentle increase in 2027. Bridge strategy or shorter-term fixed. If you are unsure, consider a 3-year fixed rate, which is often lower than a 5-year fixed. This allows you to lock in a predictable payment now, but your mortgage will renew sooner, allowing you to potentially capture the next round of lower rates projected for 2026/2027. What to consider for your personal situation. The best choice depends on your risk tolerance and financial circumstances. Just ask yourself about financial flexibility. Do you have room in your budget to absorb a potential rate increase, even if one is not expected soon? If your budget is tight, choose fixed. Term length. Are you looking for the lowest overall interest paid, lean variable, or the most stability, lean fixed? Future plans. Do you expect to sell or refinance in the next 3 to 5 years? If so, the lower breaking penalty of a variable rate is a major benefit. Final recommendation. Given that the Bank of Canada has started cutting rates and most forecasts expect a continued decline, if you have a high risk tolerance and a flexible budget, the variable rate offers the highest potential for savings. If you need absolute certainty in your monthly payments, a fixed rate, especially a shorter 3-year term, is the most prudent choice. I strongly recommend you consult with an independent Canadian mortgage broker. They have access to the most competitive rates across multiple lenders and can provide personalized advice based on your full financial picture.